It is Monday morning, June 29th, 2026, pre-market, and the futures are catching a massive, just a massive relief bid right now. We are looking at S&P 500 futures up 0.5%, and the Nasdaq 100 is up 0.6%.
Yeah, the overnight session was incredibly strong.
Right, because of that massive geopolitical catalyst. The U.S. and Iran just agreed to this formal stand-down phase to halt military strikes, and peace talks are actually resuming in Doha tomorrow. So that headline alone has just instantly cooled crude oil back down to the $69 to $72 range.
And, just to establish the ground rules right at the top here, we are strictly looking at the market mechanics of this overnight news. We're not taking any political sides regarding the administration or Iran, right?
Yeah.
What we are analyzing is simply the mechanical removal of risk premium from the energy sector.
Exactly. The rockets stop firing, oil cools off, and equities catch a bid.
Right. When that immediate supply shock threat evaporates, it allows the pre-market to gap up. But you really have to contextualize this setup for the listeners because we are walking into a holiday-shortened week.
U.S. markets are closed Friday for Independence Day.
Exactly. So trading desks are already thinning out. And, thinner liquidity always means sharper, much more violent intraday moves. We're dealing with a highly reactive tape where a tiny spark can cause just a massive fire.
Okay, let's unpack this because the geopolitical news is great, sure.
Yeah.
But last week, the Nasdaq took a brutal 4.6% hit. We saw serious tech valuation fatigue. So I'm looking at the screen right now, and I have to ask, is this bounce just a stretched rubber band snapping back temporarily, or are we looking at a true summer recovery?
It is absolutely the stretched rubber band. Until proven otherwise, this is a textbook relief rally liquidity trap.
Liquidity trap? Wow.
Yeah, because that de-escalation overnight, it triggered aggressive short covering. Traders who were betting against the market, they had to quickly buy back in to cover their positions. But the underlying macro headwinds, the exact same things that crushed tech last week, they haven't changed at all.
Which means we need to look at what's really happening beneath the surface of this morning's headline rally. You need to know where the smart money is actually flowing before that opening bell rings.
Yeah.
So what are these macro traps?
Well, we've got three main tripwires this week. First is sticky inflation. Core PCE, which is the Fed's favorite gauge, came in hot at 3.4% year over year.
Right, which the market hated.
Exactly. Second, we have hawkish pressure. Fed Chair Kevin Warsh is speaking at Sintra. Any hint from him that inflation is too stubborn and that instantly caps these equity gains. And third, and this is the big one, Thursday morning's June non-farm payrolls report.
Because it's pushed up a day for the holiday.
Right. And a hot labor print on Thursday gives the Fed a green light to maybe even hike rates in September. And
looking at the board, the bond market is practically screaming that reality right now. The 10-year Treasury yield is firm at 4.37 to 4.39%. And the U.S. dollar index, the DXY, is highly elevated, sitting around a 13-month high at 101.21 to 101.37.
Yeah, the dollar is just a wrecking ball right now.
So if I'm a retail investor holding on to crowded mega-cap tech stocks and gold, just hoping the Fed cuts rates, am I basically standing on a trapdoor right now?
You really are. You are in what institutional desks call the pain trade.
The pain trade.
Yeah. Retail is overwhelmingly positioned for a dollar debasement pivot. But with yields up near 4.4, multiple expansion for tech completely halts. You have to discount the future cash flows of these companies, making those AI valuations mathematically impossible to justify.
Plus, that strong dollar drags down international Q2 earnings because foreign sales are worth less when converted back.
Exactly. But the scariest part is the correlation shock. Retail usually relies on bonds to hedge their stocks, right? But right now, both are selling off together. We're looking at a severe risk of forced liquidations driven by convexity hedging.
Okay, wait, convexity hedging. That sounds like a textbook term. Let's translate that for a second. You're talking about mortgage-backed securities.
Yeah, MBS managers. Look, when yields spike rapidly, everyday people stop refinancing their mortgages.
Wait, because the rates are terrible.
Right. So the mortgage-backed securities that institutional managers hold take much longer to pay off. It's called duration extension. Suddenly, these managers are holding risk for way longer than their models planned for.
So their portfolios are out of balance.
Exactly. And to hedge that risk, they are forced into selling off longer-dated treasuries.
Which just drives yields even higher.
Exactly. It's a forced, self-reinforcing loop. So while retail is blindly buying the dip in tech, this yield spike and strong dollar flush out those growth portfolios.
Wow. Okay, well, here's where it gets really interesting. Because if institutions are fleeing tech, that money has to go somewhere. And the major catalyst at the open today isn't just Iran, it's the annual Russell Index reconstitution going live.
Oh yeah, trillions of dollars in passive fund rebalancing hitting the tape.
Mechanically. Plus, we have Alphabet officially joining the Dow Jones Industrial Average today, replacing Verizon.
Which is a huge structural shift for the price-weighted Dow, swapping telecom for a high-priced tech giant.
Right. But looking at the actual movers this morning, the defensive pivot is aggressive. Healthcare, the XLV ETF, is the strongest sector on the board, up 3.06%. Institutions are just running to stable yields ahead of Thursday's NFP report.
They're hiding in defense. They aren't trading the geopolitical news, they're trading the macro data.
But let's look at a completely different side of this Russell rebalance. SpaceX. The ticker SPCX is up 2% pre-market, sitting at $150. They joined the Russell 1000 and 3000 today and the Nasdaq 100 on July 7th.
Right, but the stock is down 32% from its high.
Exactly. So my question is, does a massive wave of passive mechanical buying actually fix a stock's underlying valuation issues, or is it just a temporary life raft?
It is entirely a temporary life raft. SpaceX has a relatively small public float, which means high volatility. You have billions of dollars in passive inflows colliding with that small float.
Because index funds don't care about a company's cash burn rate. If it's in the index, they have to buy it.
Mechanically forced to buy it. So the bull case here is that this passive buying bounces the stock off that psychological $150 floor, pushing it back toward the 175 to 180 zone.
And the bear case.
The bear case is that if institutional fears over that group-level cash burn override the passive flows and that 150 floor breaks, it opens up a violent retest of the $135 IPO level. Passive flows provide liquidity, but they don't fix fundamentals.
Gravity eventually wins.
Always.
Well, speaking of fundamentals, that brings us to the single stock inflection points moving violently today. Let's look at the absolute floor first. Nike.
Oh, man. Nike.
Yeah, NKE is trading near a 10-year low this morning, right around $40.75 to 40.91 ahead of Q4 earnings tomorrow. Wall Street is just deeply pessimistic on China demand.
Yeah, targets have been slashed to $43 and $60.
So how do you even trade a blue chip at a decade low like this?
You look at the positioning, expectations are literally on the floor. Short interest is massive. The bear trade is so crowded that any optimism on fiscal 2027 guidance from their incoming CFO, David Denton, could trigger a massive short covering squeeze.
Because shorts have to buy the stock back to close their positions, which just rockets the price higher.
Exactly. A squeeze could push it violently toward $43 to $44, but, a breakdown from here targets 35 to 36. It's a pure binary positioning trade.
Now, contrast that floor with the ceiling we are seeing in ABBV, ticker ABBV. They're on a 17% 5-day winning streak, hitting a 52-week high of $253.35.
Just an absolute monster run.
They just dropped almost $11 billion on ABBV Therapeutics, and they got EU approval for Rinvoq this morning. But, trees don't grow to the sky. Is this momentum sustainable, or is this just a horribly crowded trade waiting to correct?
Well, you have to look at the why. For years, the street was terrified of the Humira patent cliff.
Right, losing their golden goose.
Exactly. But Rinvoq and Skyrizi are actually offsetting that cliff now, and the market is repricing the stock to reflect that survival. The bull case targets the $262 analyst consensus.
But after a 17% run in 5 days, in a low liquidity week.
Yeah, that's the bear case, short-term overextension. Traders might use this EU news to finally take profits, which targets a pullback to the 230 to 235 breakout support.
Okay, so what does this all mean for the broad market? Let's bring all these macro yields, sector rotations, and individual tickers back to the major indices. We need the technical roadmap for the day.
Let's start with the S&P 500, the ES futures. Current action has us sitting right in the 7,447 to 7,451 range.
Okay.
The ultimate support floor, the absolute line in the sand, is the June 11th demand zone, down at 7323.75 to 73.78.
And overhead.
Key overhead resistance is 74.80 to 74.95. And keep in mind, the options market is currently pricing in a 119 point or 1.6% weekly expected move.
Wow, a 1.6% move. But with the auction skew tilted so heavily to the downside, It sounds like Wall Street is just paying a massive premium for earthquake insurance right now.
Oh, they definitely are. Because they are watching the NASDAQ 100 futures, which, they're rebounding aggressively this morning, up about 298 points.
Yeah.
But they must hold last week's swing lows.
Or else the floor falls out.
Exactly. And the AI narrative is facing a huge fundamental stress test right now. Look at Apple.
Yeah, I saw that. They are actually hiking prices on iPads and MacBooks.
Not for margins, though. It's due to soaring memory and storage chip costs. The infrastructure to run AI is making basic consumer tech way too expensive to produce.
Which stokes massive consumer demand fears. If the hardware gets too expensive, the consumer stops buying. And those astronomical AI valuations we talked about earlier, they just collapse.
Precisely. It's an industry eating its own tail.
So let's distill this down for the listener. The mission of this deep dive was to answer, is this geopolitical truce sparking a sustainable rally, or are we walking into a liquidity trap?
And the data says it's a trap.
The overnight relief bounce is masking an incredibly dangerous low liquidity week. We've got sticky inflation, hawkish Fed speakers, and Thursday's jobs report looming large. Yields are elevated, the dollar is strong, and it's actively liquidating that speculative froth.
So your strategy today has to be capital preservation. Until that 10-year yield finds a real ceiling, do not chase this early morning gap up blindly. Watch that 7480 S&P resistance level like a hawk. If it fails, the trap springs.
Stay disciplined out there. But before we go, I want to leave you with one final, slightly terrifying thought to ponder on your own. We just saw how a slight increase in raw chip costs forced Apple to hike prices, which in turn shook the entire NASDAQ. Real-world economics at play.
Right.
But at the exact same time, today, trillions of dollars are being blindly pumped into the market through passive index funds for the Russell reconstitution, mechanically buying up companies regardless of their cash burn or fundamental health. It begs the question, at what point does passive investing stop reflecting the real-world economy and start dictating it? Keep your eyes on the tape, respect the traps, and good luck out there.